Investing is already hard enough. We have to sacrifice our spending, risk our hard-earned money, all of that just to be in the red. And we can see that by the 20-year annualized returns by asset class, where the average investor is right at the end of the list with an average of 2.5% return, while the S&P 500 is all the way up the beginning of the list with a 6.1% average return. Charlie Munger says that the big problem for the average investor is that they think they can predict the future, but I think that it's because investing is actually very hard. Emotions play a big game, but additionally, if you choose to stock pick, this adds 1,000 layers of difficulty, because apart from your emotions, having to sacrifice spending, and having to risk your capital, you also have to choose stocks, read annual reports, digest the macroeconomic environment, research all the different competitors, and all that work just to have a mere 12% chance of actually outperforming the S&P 500. This information, by the way, is the percentage of funds which underperform the benchmark. These funds are composed by investing professionals which are paid millions of dollars every single year with one single purpose: outperform the S&P 500. If 88% of them cannot do this, then this of course shines light on why the average investor who has a day job and is doing this whenever they can find a time and the will to actually read through annual reports, filter through companies, do the due diligence, and then actually try and build a portfolio to outperform the S&P 500. Well, this is why I actually believe that there is a simpler way. Just by investing in ETFs and tracking the index, you remove a lot of complications, and if you automate the process, well, you even remove emotions, which is the hardest part of investing. And one of the main reasons for this disparity in performance is that we tend to hold on to ETFs for a lot longer than we tend to hold on for stocks, as the average holding period for stocks is 5 months, while the average holding period for ETFs is 2 years. But the graph in this slide shows the frequency of the stock market actually being positive by holding time, meaning that if you held the stock market or the S&P 500 only 1 month, well, there is a 63% probability that you actually made some money. But if you held it for 15 years, then there is no period in time when you actually lost money. And of course, this is because the fundamentals for stocks vary so much from one quarter to the next one. However, with ETFs, since they balance themselves out and they follow index, since you have professionals on the other hand actually taking care of this information, you don't have to do much anyways, so it's a lot simpler to hold on for a long period of time. But what exactly is an ETF? Well, it actually stands for an exchange-traded fund. It's like an investment vehicle where you can actually purchase a participation in it, and it usually holds either stocks, bonds, commodities, and a large amount of different investments. These can generally be passive, which means that they track indices which are already built and they just conduct some sort of replication, or they can be actively managed, which means that there are investment professionals behind them trying to outperform the indices. Over here you can see a list of 6 different types of ETFs, starting with the most common one, which are the index ETFs. This is any kind of ETF which tracks any kind of index, from the S&P 500 to the all-country world index to bond indices, real estate indices, and other type of already made benchmarks. Number 2 are commodity ETFs. These basically track the price of either a specific commodity or a group of commodities. For example, there are many ETFs which track the price of gold, silver, platinum, but also wheat or even oil. Number 3 are inverse ETFs. And these work the same as any other kind of ETF, but when the price goes up, you lose money, and when the price goes down, you actually earn money. Think about it as shorting an ETF. Number 4 are actively managed ETFs, and as we stated previously, the entire purpose for these ETFs is for an investment manager behind it to try and outperform an index, instead of only track them. However, these usually have a way higher fee than all the other type of ETFs, and as we saw in the previous slides, over 88% of these funds actually fail to beat the index, so at the end of the day, you're paying more and the performance will be lower. Number 5 are foreign market ETFs. Now these are generally ETFs which track indices or which invest in different type of companies or bonds in non-US markets. This can be either Europe, Japan, China, or any other geography that you can think of that excludes the USA. And last but not least, these are a newer type of ETFs, and they're industry-specific ETFs. These provide exposure to particular industries. For example, there is a very popular AI ETF which invests in the leaders in AI, for example, in Microsoft and in other smaller kind of companies which are benefiting and launching a lot of AI products. Now, the most famous of any kind of ETF are those which are actually tracking the S&P 500. These are the ETFs which have the highest volume, highest liquidity, and highest assets under management. And the way that this works is that they hold inside them a lot of different investments. In the case of the S&P 500, well, you didn't guess it. They hold 503 stocks inside it, with different allocations, which change based on how valuable these companies are. And when you deposit $100 into the S&P 500, well, your $100 will be split among the different companies inside the index based on the percentage that they make of the entire index. But the thing with ETFs is that you don't only have to buy one. You can try different mixes. You can mix commodity ETFs with index ETFs, with foreign ETFs to create your own personalized portfolio based on what you believe that will actually happen to the economy and based on what you feel comfortable holding. The most famous mix of ETFs is the all-weather portfolio composition, which was created by Ray Dalio, and as the name states, the whole purpose of this portfolio is that it performs well in recessions, in economic booms, when inflation is high, when inflation is low. There are different asset classes which outperform in different economic environments. And down below you can see that you mix 5 different ETFs with different allocations in order to get this solid portfolio which is built with different ETFs. But now if you actually want to venture and create your own portfolio of ETFs, I have to tell you that the ETF selection process is not that simple. Once you have created the portfolio and once you are investing in the ETFs, it's very simple because you just have to add in more money and the fund managers or the index will actually take care of everything for you. However, there are many things to consider. For example, which index or which asset class will you track? You have to check the different expense ratios for the ETFs, because there are many funds which track the same index, have the same allocation, the same currency, and the same everything, but they have vastly different expense ratios, so that is something to check. Adding to this, you have to check for the ETF and underlying currencies, because these may affect you in a different way, especially if you're not American. Most of these funds have some sort of tracking errors, which is how much their returns and how much their price action actually deviates from the index itself, because this replication process is not perfect. They try to imitate the indices, but some ETFs are better than others at doing this. And another point is that there are many ETFs which distribute all of their dividends, and there are many that accumulate. Distribute means that they pay the dividends out to the holders of the ETFs, and accumulating basically means that any dividends paid out by the companies inside the S&P 500, for example, will be reinvested back into the ETF without you being able to touch it. And these are only 5 different aspects. There are hundreds. And as Jack Bogle actually stated, who is the founder of Vanguard, by the way, talking about ETFs is like talking about people. There are good ones and there are bad ones. So before actually buying some ETFs, you have to do your due diligence. And one of my favorite things to do with ETFs is to backtest. This tool and this analysis is essential for you to actually be sure about what you're investing in and optimize your allocations. There are many softwares where you basically enter your portfolio allocations, for example, 30% into stocks and 70% into bonds, and they will simulate how this would have performed over the past 20 years or so and give you the return, the volatility, the standard deviation, the maximum drawdown, every single analytic that you can think of to allow you to compare this portfolio with different ETF allocations or with even different portfolios. I have used this in the past and it's helped me maximize my return while minimizing my risk. However, I would like to read the quote by Ivan Wei, where he states that patterns don't work 100% of the time, but they are still critical because they help you define your risk. And this is the nicer way of saying that past performance is not an indicator of future returns. So although you do a backtest, you do have to keep in mind that the results from now onwards may be extremely different, which is why you should take this with a grain of salt, but it can actually help you define and perform those final adjustments to your ETF portfolio. But in order to create a successful investing strategy into ETFs, I think there is a clear 6-step guide. Starting with goal setting. Well, you have to define your objective, why you want to invest in ETFs, and your time frames. Will I do this for the next 5 years only? Or am I planning to keep all of my capital inside until retirement? Next, you need to define your holdings. You need to set your asset allocation, how much you will add to stocks, how much you will invest in stocks, how much in bonds, how much in commodities, and make sure that this is aligned with your beliefs in the economy and your investment thesis, your investment objectives, and your risk profile. Then number 3 is the dirty work. You have to start to research ETFs. My recommendation would be to build a list of ETFs for each of the different allocation or asset classes that you want to have. So for example, if you want to invest in stocks, bonds, and also gold, I would recommend to have a list of around 5 ETFs for each one of these asset classes with all the relevant information, the fees, the currencies, the tracking errors, and this will allow you to make a better decision because in the next step, you will have to actually filter down these ETFs based on that information. You do this in order to pick the one that suits you the best or in order to pick the cheapest one, which is normally how this goes. And once you do this, I would recommend you to conduct some back testing. This will allow you to tailor your portfolio to your final allocations so that you can sleep better at night and you can leave your portfolio automated knowing that you've done the correct research. And finally, you just have to define your investing methodology. How much will you invest? How frequently? Will you increase these contributions? Will you rebalance your portfolio? And even more questions like the ones you're seeing here. And these are just a few of the questions that you should be asking yourself. I believe that defining your investment method is extremely important because when times get tough, you will need guidance, and this guidance is better done at the start when you know your objective, when you know your goal, and when you know exactly what is inside your portfolio. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.